Welcome to the Wealth Matters podcast, where investors come together to better understand how to build passive cash flow and create generational wealth without all the confusing mumbo-jumbo. Here's your host and co-author of Amazon #1 bestseller, Alpesh Pamar.
Welcome to Wealth Matters podcast. I am going to talk to Mr. Jerry Fetta today. He's the CEO and founder of Wealth DynamX. He's a published author, successful entrepreneur, investor, and a nationally recognized financial expert featured in Forbes, Yahoo Finance, Chicago Weekly News, New York Finance, etc. So I think he has had affiliations with names like Grant Cardone, Dave Ramsey, Pamela Yellen. So I'm looking forward to this episode myself. I want to know how I can reduce taxes or not pay any tax on the money I make. So I'm looking to learn a lot. Actually, I just found out Jerry gave away his first business to a colleague and started with nothing. That's when he founded Wealth DynamX, a wealth creation firm that helps clients across the US build wealth. So welcome, Jerry.
Hey, thank you so much for having me on today, Alpesh.
Absolutely. So Jerry, I asked this question to everyone. Tell us something interesting or funny about yourself.
Interesting or funny about myself? So I think interesting fact would be in high school, I was a competitive amateur bodybuilder. So I did that from the age of 16 till about 21. And then what's funny about that is because I would stand on stage basically in a Speedo, right? Flexing my muscles in front of everybody. I'm very good at public speaking now because I'm not afraid to stand in front of people. So
you will never be embarrassed.
Exactly.
No, that's so do you do bodybuilding now or do you work out? I'm pretty sure you do.
I work out. I don't compete anymore. Yeah.
Okay.
I don't do the competitions, but I still hit the gym every day.
Okay. Yeah. I love working out. That's what I do almost every day. So I always ask everyone when someone talks about working out. So one question I have, because I was looking through your bio, why did you look into wealth creation through tax reduction?
So taxes are one of those things that, you know, as you build more income, as you build more wealth, it actually becomes a bigger expense, which is unique. A lot of things as you grow your income, it's a fixed expense. And so it represents a smaller and smaller percentage, not taxes. The percentage climbs as your net profits go up. Oh. So if you're able to keep that, you're able to, you know, save more, invest more, build more wealth faster. And I also just don't like paying taxes. A lot of times, depending on where you're at, it may or may not go to good things. I think a lot of times we can do better things with that money in our own lives and our own communities.
I agree. And I'm just remembering the quote from Tom Wheelwright, Robert Kiyosaki's CPA, right? The biggest expense in your life is taxes. Right. And I asked this question to a lot of my friends and they're like, oh, yeah, you know, the mortgage, this, that. I'm like, no, taxes are always going to be the biggest expense in your life.
It's true. And the, you know, a lot of the times when we look at taxes, we don't always realize what they're for. If you learn about like the Federal Reserve banking system, you realize a lot of that income tax is just paying interest on debt that the Treasury borrows from the Fed. I'm not super psyched about that. Kind of being in the position where I'm paying that off.
Yeah. And they're going to continue to spend or, you know, print the free money, right? And continue to use our money to pay off just the interest, not
which means the taxes
debt.
Will go up.
Yes, that's what it seems like, at least with this government. So I have another question, which I saw in your bio, how to build wealth like the top 1%, right? It seems you have a step-by-step sequence, right? So can you share us?
Yeah. So I actually wrote this last year as a book called The Blueprint to Financial Freedom. And actually it was in 2020. I'm getting my years mixed up. I wrote this and published this in 2020. And basically what it is a step-by-step sequence on how to, like you said, create wealth like the top 1%. I used to be a licensed mainstream financial advisor way back in the day. And so there was a point in my career where I realized that there were other things than stocks and bonds and mutual funds and 401k plans. And I didn't realize that initially. And I started learning more about this. And I started researching, well, what did the wealthy actually do? You know, if we look back 100, 200 years, where were they actually putting their money? What did their strategies actually look like? And so that really is what I learned. I spent a lot of time researching this and actually applying it in my own life. And it works. It's a very, very good plan, a very good system. One of the things that I learned is that the wealthy like to invest in hard, tangible assets that pay income. They're not big on retail financial products.
Even if they end up making money from retail or financial products, like we were talking about Bill Gates, right? Just an example. that he did make a lot of money from Microsoft stocks and owning Microsoft. But where is he now? Where does he invest right now? A lot of his money is going into, as you said, multifamily. And as far as I know, he's now the largest landowner in America, right? So
Yeah.
there's a reason why, because
You got to
he
pay
knows,
attention to that.
yeah, he knows that real estate is the way to keep your money with you, right? Even if you make it from Wall Street or Main Street, wherever.
Yeah. And one thing that I pay attention to, Alpesh, with these wealthy individuals, especially with social media, there's Twitter and Facebook and Instagram. We can actually follow some of these top 1% guys now, which is incredible. But I always pay attention to the old adage, do what they do, not what they say.
Right.
And so, they might say, go buy the mutual fund. Warren Buffett, for example, says never invest in gold. And then he buys a bunch of it back in the late 90s and makes billions off of it. Elon, you mentioned with Bitcoin, right before he got into Bitcoin, he was anti-Bitcoin.
Yeah.
He's like, never buy it. Then he got into it, said we now offer it. Now we don't, pumped it, dumped it, got a bunch out of it. So
and
I have to pay attention to these guys.
Exactly. And only one thing I wanted to talk about Elon Musk is that if you look at Tesla's balance sheet, Tesla became profitable because of Bitcoin. If you go back and study the last 2 years, Tesla is only profitable because of, when they sold the Bitcoin. If you remove the Bitcoin profit and if you remove all the government subsidies, Tesla is in negative.
Yeah,
but people don't realize that.
it's crazy because they're like a super high valuation. I think Musk is the wealthiest guy in the world right now.
Of course.
Yeah, I think I checked in 2020 because I was looking at that same thing and I was looking at their price earnings ratio.
Yes.
And it was worse than the yield on a savings account.
Exactly. It's one of the worst. And I was researching last 2 years as you did. I was like, wow, they are actually losing money every year if you remove all the government subsidies.
Yeah.
And they're only profitable because there is Bitcoin profit.
Yeah.
And Dogecoin or whatever.
Exactly.
I have one question which I really want to know about, right? And because I think all of my listeners want to know how to not pay your taxes and get away with it.
Very good question. And it's important to put the get away with it, making it legal, because anyone can just not pay them, right? And then you get audited and then you go to jail and you're there for a while.
We want to know about the legal loopholes.
Exactly. So here's how I like to break this down, Alpesh. The tax code itself is about 6,000 pages in length with just code, not case notes and everything, just the code itself. Only about 70 pages, I believe it's about 70, have to do with the paying of taxes.
Right.
Which means the other 5,930 some odd pages are basically ways to not pay. Right. So, when you look at income, there's different types of income. And I tell my clients this all the time. You've got to pay attention to how you're earning your income and how it's classified. What types of structures it goes into. Are you expensing those off? Are you able to depreciate against them? There's a number of different strategies that you can, take money and put it into, various tax reduction trusts. You can get tax reduction that way. So there's so many ways, and I can show almost anybody how to pay zero, but it comes down to, number one, is it per the tax code? Is it legal? Right. And then number two, I also have to look at, I don't want to put money away and reduce taxes, but then not be able to make smart decisions by investing the money after. So if the only thing I'm getting is a tax deduction, usually I'm not going to do it because I still want control of the money and I still want to be able to invest it.
And we want that money to grow as well.
Yeah. So there's a lot of ways to go into it. For example, one of my favorites, it's an easy one. It's called a Section 179 deduction.
Yes.
If you're a business owner, you can purchase a vehicle that weighs over 6,000 pounds. So I did that borrowing against my life insurance, used that to then finance the vehicle to myself. So I get the tax deduction, but I'm also getting the arbitrage because my life insurance still grows while I'm borrowing that money. Correct. So I'm basically making money 2 places in one location at the same time on this vehicle.
Oh, that's awesome. Can you share some other strategies as well? So I know Section 179. Of course, all of us know about the real estate depreciation and, the other one you mentioned, right, where you want to control and you want your money to grow. So, of course, you don't want to put money in a conservation easement. Like, do you have any other strategies?
So there's another one called the Augusta rule. So this one is for homeowners. So if you own a house, it's got to be a primary residence. As long as you don't have a home office in that house and you're a business owner, you've got to have an S corporation. So you can't be a sole proprietor. your S corporation can rent your house from you 14 days a year. And basically it can pay market rate. So you can charge whatever you'd charge for the Hilton or the Marriott to use a hotel room and a meeting room. You can do that 14 days a year. And basically the income that you as an individual would receive from your corporation is tax-free. And then your corporation gets a tax deduction. And so basically you're able to wash out, let's say you can do $1,000 a day, for example. And I'm not telling you this is the rate. You got to go do your research.
Right. Yes,
if it's $1,000 a day, that's a $14,000 a year tax deduction you get.
No, that's awesome. Is there any strategy W2 high income earning W2 can apply? Because most of these strategies are for business owners.
Yeah. So that's a tough one. If you're a W2, you know, and I'm not even a fan of the 401k. So I'm not going to tell you max out your 401k because you're locking your money up with Wall Street for 4 years. You lose
all the control and you are investing in some trash ETFs and mutual funds.
Exactly. One of my mentors calls it the soup of the day. You're getting the leftovers. So if you're a W2, there's something called a charitable lead trust. And a charitable lead trust allows you to set up a charitable trust. The money that you put in the trust basically it's almost like you're leasing it to a nonprofit. So you can pick a charity that it's going to go to. That money has to get paid back to you at some point. And so what that means is I get to get the tax deduction now on the full amount that I put into the trust. While they're using my funds, it's also able to be invested. So I can put it into a charity that might put it into mobile homes or crypto or whatever. And then there's a repayment that has to happen from the nonprofit back to my trust. Now, what happens is immediately I get a tax deduction up front. And then when it gets returned back, it's kind of a return of principal. So I'm going to pay a little bit of taxes based on the profit spread. Let's say, you know, they made money while they were using it and while they were investing it and they paid me back at a profit. I might owe a little bit on the back end with that, but typically when I set this up correctly, I can get a large tax deduction against my W2 income. And it's money that ultimately, if I'm in touch with the charity and I talk to them, I can kind of direct where I would like them to invest it for me. So it's not necessarily going to go into those crappy ETFs and mutual funds. It could go to something that's an asset class that I believe in.
Oh, that one is interesting. So it's not same as I know there is something called charitable remainder trust, right? This is different. Charitable
a little bit different. Trust. Yeah. And the remainder trust works as well. If you're a W2, the lead trust gives you a little bit of leverage because there's a mathematical formula that you would use basically to calculate the future value of what that money will be worth, you know, when it comes back to you. So if you were to put in, you know, $1, you might be able to deduct more than that $1 versus on a CRT, a charitable remainder trust. If I put in $1, I'm just going to deduct that dollar.
Okay. CLT works similar to more like conservation easements, right? You put $1 and you can write off like $1.75 or $2 or something.
But you actually get something back.
Yes. Yeah. You don't lose everything. So the only thing, and I'm just trying to figure this out. I want to understand. So CLT, let's say I'm giving $10,000 and then the charity cannot just use the money. They have to invest or they actually use it for charitable purposes.
So I'm not an attorney. My legal firm handles these, but typically they would have the ability to use it, but they would also have the future commitment of repaying it. So
I see.
They have a little bit of free reign there, but if they're smart, you know, they might spend some of it fund operations, but they also do know, hey, I've got this repayment that has to happen. And so I've got to be able to pay that back. And so that's where the investing kind of becomes a necessity.
I see. So only a couple of things I can think of is one, either the charity disappears in 10 years, right? By the time they need to pay me back, or second, they don't have any money to pay me back.
Right. Yeah. And that's where, you know, with anything you put money into, the tax structure is IRS code, right? So you're really just using an IRS code. But when you utilize that tax structure, whoever you're giving it to and wherever you're investing, you still want to do your due diligence, right? Yes. 401k, just an internal revenue code, right? But if I put it with a wealth manager or a mutual fund, inside that 401k, they could lose all my money and I might not get anything back.
Yeah, same thing with any investment. I agree. So there was another question I had. And again, this was from your book and stuff, how to make money while paying off debt. And making debt an instrument for your or investment for your future.
Yes. So this is specifically going to be with consumer debt. You know, there's a difference between debt that is on consumption versus debt that's based on production. So, you know, we're talking car loans and credit cards and student loans.
Bad debts.
And it's kind of the dirty little secret that a lot of Americans have, but they're not talking about it. We're all ashamed to mention like we have debt. Yeah. So, you know, the big thing to realize is if you have debt, if you fly above it, because as a consumer, it can feel a little bit, emotional, where I'm like, I have this debt and it's, something I'm ashamed of or nervous about or afraid of or I'm worried about. If you fly above it emotionally, what that means is it means you asset to the bank. They're going to get a percentage of your income until you pay them back with interest. So it's kind of like with, we mentioned mobile homes. You kind of are the mobile home, right? Like you're producing a yield for them. So when I'm paying off debt, I like to actually reword it. And I like to say you're buying debt back, right? Because in the terms of banking, when they buy a note or they issue debt with somebody, they're going to trade that amongst the other banksters, right? And so that's called, repurchasing debt or selling debt. So what I'm really doing is when I'm paying debt, I'm actually buying it back from the bank. I'm saying, hey, I have X amount in principal. I want to buy my debt back from you. I no longer will pay you and I get to keep all my income and I don't have to pay the interest. So that's the mindset of the investor. Now, the way that you make money on this is you set up it's called a high early cash value life insurance policy.
Yeah, that's
so
what
you
I
use
have.
whole life insurance and you've got to structure it correctly. There's 99 million ways to structure it wrong. There's one way to structure it right. And so you have to use the right structure. When you do this correctly, if you put $1 in, that dollar grows at about 3 to 5% on an annual basis, on average, tax-free. You can borrow against that dollar, right? That dollar will still be earning 3 to 5% while you borrow against it. Your effective interest rate might be 1 to 3% in total cost. So if you do this correctly, you're paying, let's say you're making 4, you're paying 2, there's a positive spread there. Yes. Now, when I borrow it, I'm going to use that now to go pay off the entire debt. I'm going to take my smallest balance. I'm going to pay it off with the bank. I'm going to buy it back. Whatever my minimum payment used to be, I'm going to now pay that back to myself. I'm going to pay my life insurance loan off. What this does is it gets rid of the debt and it accelerates it, but also all of my principal is still growing. And so when I'm done with this, it's been compounding the entire time. Because as you know, money, currency and debt are like matter and antimatter. If I mix a dollar with currency with $1 of debt, they're both gone forever and I can never use them again.
So, and we spoke about, so high cash value life insurance, of course, taxes, and also you had mentioned tangible assets, right? So how hard assets can protect you against inflation? And the question is it's like perfect timing. We just saw that the inflation hit 7%. Right?
Yeah, which means it's probably like 15.
Yeah, exactly. Yeah, 7% is on the government books. You're right.
Yeah.
So how hard assets can protect you against inflation?
So I'm a big owner of gold and silver, physical gold and silver. So it's not ETFs, it's not paper, it's not digits, it's actual gold and silver. And so this goes all the way back to 1971. So in 1971, the US dollar was backed by gold. And so what that meant was that dollars were actually priced in gold. Mm-hmm. Right. And it kind of goes back to basic arithmetic in elementary school. We learned about the numerator and the denominator. Right. So we're saying dollars, the numerator, were denominated or priced in gold. Right. And so that got flipped. And so now they're saying post 1971, gold is now priced in dollars. Now, in math, you can't just flip the numerator and the denominator. It doesn't solve the same problem anymore. And so for me, I like to buy gold. It does have an inflation adjustment component. But for me, at the end of the day, it's the only store of value other than real estate that has been around and stood the test of time. 6,000-year track record of being there as a store of value. That's not a currency. We're not going to go buy groceries with it and pay for gas. But if I buy, I think the number that I saw, Alpesh, is if I bought a suit in 1913,
yes,
it would have cost 1 ounce of gold. Okay, that same suit today still costs 1 ounce of gold. And so that's really the inflation adjustment of using gold. Gold also is another one you can borrow against. So if it's, let's say, making a compounding annual growth rate, let's say long-term of 8%, I can borrow against it as collateral on a line of credit and pay, again, like 2 to 3% interest cost. And then I can actually go buy mobile home parks or do private lending. And so I can double dip on my earnings with it so that it does bring in a yield. I can also lease it out as well. So it's very versatile. I'm also a simple guy, so I like what I can see and hold, and gold does that for me.
Yeah. So a couple of interesting things you mentioned. I mean, so I was a proponent of gold, but I don't do it anymore because it hasn't done much in last 10 years. But a couple of things you brought up ignited an interest for me again, is that how do I get a loan against my gold, right? Like collateral. Do I have to put my gold in one of the, I think the facilities where I forgot the name. It was the
like a depository.
Yeah, depository.
Yeah.
ADRs. Yeah.
Yeah. So you would put it with a depository. There aren't a ton of banks that do this. So you've got to
Right.
find the right groups to work with. You put it within a depository. It is secured. It is fully allocated and segregated. So it's not being commingled, mixed, anything like that. It's also insured. And then basically they'll issue typically 75% loan to value. So if I've got $100,000 worth of gold, I can take 75 grand from that on a line of credit. And I'm going to, again, usually I like to do secured private lending. So I'm going to loan it on an asset. I'm going to be the mortgage, on a note type of deal that's going to pay me interest. And my interest rate that I earn might be 12%. And meanwhile, I'm paying 2 or 3% to borrow that money. Long-term gold appreciates since I get both ends of that deal.
I see. And how do you lease gold? Because you also mentioned about leasing.
Yeah, so this is one that's been around a while. So a lot of gold, not only dealers and wholesalers, but also even in the jewelry business, just like on a car dealership, they don't own their inventory. They lease it, right?
Really?
And then what they do is when they sell the dealership, they sell the car, then they can pay off their lease and they basically will go do another one. So they have more inventory. A lot of gold dealerships work the same. And so with gold leasing, you're actually directly leasing your physical metal to a dealer. And then that dealer is paying a lease payment. And it's typically a shorter term deal. It might be 12 months and they're going to pay you maybe 2 to 4% interest for that year. And then at the end of the 12 months, they have to pay principal back. And so that's kind of how those work. And those are generally going to be, again, based on, you want to lease to the right people, based on people that have high revenue, good credit, and they don't have defaults in their history. And so then for a fact, just like with a dealership, this lessee is going to pay us back with interest and also return the principal value at the end.
Oh, that's awesome. This was great. So let's take a quick break. And after the break, we'll go to the same questions I ask every guest.
Sounds good. Let's do it.
You're listening to the Wealth Matters Podcast. The Wealth Matters Podcast. For more info about what we do, check us out at wealthmatters.com. It's wealth, WEALTH, matters, MATRS.com.
Welcome back to Wealth Matters Podcast. Jerry shared a lot of golden nuggets about hard assets, how to not pay your taxes and get away with it. So I'm very excited for this episode because I learned a lot already about gold. Jerry, are you ready for fire round?
Let's do it.
Would you be changing any business or investment strategy after this pandemic is over?
I actually did already. So we used to have an office in a physical location in Alaska. It was about 3,000 square feet.
Alaska.
Yes, that's where I lived. I lived there for about 20 years. We got rid of that, moved to Florida, and now we're cloud-based. So I think I'm going to keep with that for a while. I kind of like the remote thing.
Yeah, and it saves money. And of course, it's the flexibility is great, right?
Yeah.
Oh, that's great. Favorite real estate or finance or any other related book?
I would say my favorite book is a book called Becoming Your Own Banker, and it's by Nelson Nash.
By Nelson, yeah. That's about the high cash value life insurance.
Yeah, amazing concept.
Yeah. Any tool or website you recommend or you cannot live without?
I would say the tool that I probably use the most is a present value and future value calculator. So you can get that on most finance apps or advanced calculators will have one, but it helps me just count, discounted cash flows, compounding annual growth rates, and future values.
That's awesome. Any advice for beginner investors?
Invest in your own knowledge first. The number one risk to a new investor is themselves, right? And we hear a lot about diversify to mitigate risk. Well, if you understand your investments, you really don't want to diversify. You want to go in on the things you know. So learn a lot, read books, go to conferences, do everything you can to become an intelligent investor.
That's a great advice. How do you give back?
So I do a lot of charitable donations, with my churches and charities that I'm a part of. I also work with a company that actually does a percentage of all of their profits to a organization called Feed My Starving Children. I was actually talking with the CEO of that group today, and I think it's a bullion business. With our bullion business, we feed about 3,000 to 4,000 starving children per month, and that's global. So that's what I like to do to give back. I don't like the phrase give back because it makes it sound like you took something. Right. So I just like to say give. I like to be generous. I like to give.
Oh, that's a great idea. Thank you so much, Jerry. How can my listeners reach out to you?
So follow me on Instagram. If you go to @JerryFetta, you can follow me there. We do a ton of great free content. If you'd like to grab a free chapter of my new book, you can go to jerryfetta.com/free chapter as well. And you can do that there. And then if you just go to our website, wealthdynamx.com, we do a lot of articles, videos, podcasts, and we try and just get as much financial education and truth about money out there as we can.
It's awesome. Thank you so much, Jerry, for your time today.
My pleasure. Thank you, Alpesh.
Thanks for listening to the Wealth Matters podcast. If you enjoyed it, please leave us a 5-star rating on iTunes so others can enjoy the show too. Have a great week and happy investing!